What if the next massive move in Bitcoin, the kind of move that shocks the entire financial world, is already forming right now on the chart? Not because of hype, not because of headlines, and not because of social media speculation, but because of a pattern that one of the most respected traders in the world has quietly identified. A pattern he calls the banana split. And at the exact same time this unusual chart structure is appearing, something else is happening deep inside the Bitcoin market. Bitcoin is disappearing from exchanges, quietly, steadily, relentlessly. In fact, the amount of Bitcoin available for trading on exchanges has just fallen to the lowest level in history, which raises a powerful question. What happens to the price of an asset when supply keeps shrinking, but global demand keeps growing? Because if history is any guide, the answer could be explosive. To understand why this moment matters, we need to begin with what just happened in the market. Bitcoin recently climbed back toward the $71,000 level, signaling renewed strength after months of difficult price action. For much of the past 5 months, Bitcoin had struggled. The market closed multiple months in the red, leaving many traders uncertain about where the next major trend would begin. But as the new month started, something changed. Bitcoin began to recover, slowly at first, then more decisively. Prices pushed higher, climbing more than 4.6% and eventually touching the $71,000 mark. That move caught the attention of veteran trader Peter Brandt. For those unfamiliar with his name, Peter Brandt is not just another crypto analyst posting predictions online. He is a trader with more than 50 decades of market experience, known for identifying long-term chart structures across commodities, currencies, and cryptocurrencies. Brandt has traded through bull markets, bear markets, crashes, and financial crises. So when he points out a pattern in Bitcoin, the market tends to pay attention. And this time, what he shared was something unusual. A chart showing Bitcoin moving inside a long-term curved structure. Instead of the traditional straight trend lines many traders use, Brandt highlighted something more organic, a large arc guiding Bitcoin's price over time. He calls this arc the Big Banana. The name may sound humorous, but the implications are serious. According to Brandt's chart, Bitcoin has been moving along this curved path for years. Markets rarely move in perfect straight lines. Instead, they expand and contract in cycles. Momentum builds, then fades, then builds again. The curved structure on Brandt's chart reflects exactly that kind of behavior. But inside this larger structure, another pattern is now emerging. A smaller arc, a smaller curve. Brandt calls it the little banana. This smaller formation appears to be developing inside the larger long-term trend. In other words, the current Bitcoin price action may simply be a consolidation phase occurring within a much larger bullish structure. When markets consolidate, they often move sideways for extended periods. Prices bounce between support and resistance. Traders become impatient. Some investors lose confidence. But consolidation phases are not always signs of weakness. Often, they are periods where markets gather energy before the next major move. Think of it like compressing a spring. The tighter the compression becomes, the more powerful the eventual release. Brandt suggests that the current little banana pattern could represent exactly that type of compression, a temporary pause, a sideways movement, before the next major expansion phase begins. Another interesting detail in Brandt's analysis involves time cycles. According to his chart observations, Bitcoin tends to move through repeating phases that last roughly 52 weeks, about a year. During these cycles, Bitcoin often transitions from a consolidation period into a strong expansion period where prices move much faster. This kind of cyclical behavior has appeared multiple times in Bitcoin's history. Periods of quiet accumulation, followed by explosive rallies. Periods where the market seems stagnant, followed by dramatic price acceleration. If the current pattern follows a similar structure, then Bitcoin may be approaching another moment where momentum begins. Traders move their coins onto exchanges when they plan to trade or liquidate positions. But when investors withdraw Bitcoin from exchanges, it often signals a different intention: long-term storage, self-custody, holding rather than selling. And according to data from the blockchain analytics platform CryptoQuant, exchange reserves have been falling dramatically. Back in 2023, exchanges collectively held more than 3.2 million Bitcoin. Today, that number has dropped to roughly 2.7 million. That means about 500,000 Bitcoin have been removed from exchanges over that period. 500,000 coins. To put that into perspective, at a price near $70,000 per Bitcoin, that represents roughly $35 billion worth of Bitcoin leaving exchanges. That's not a small shift. That's a massive supply movement. And it suggests something important about investor behavior. Many Bitcoin holders are choosing not to keep their coins on exchanges. Instead, they are moving them into private wallets, cold storage, long-term holdings. This trend matters because Bitcoin operates under a unique economic structure. Unlike traditional currencies, Bitcoin has a fixed maximum supply. There will never be more than 21 million coins. This limit is built directly into the Bitcoin protocol. No central bank can change it. No government can print more. And recently, the Bitcoin network passed another major milestone. More than 20 million Bitcoin have now been mined. That means over 95% of all Bitcoin that will ever exist is already in circulation. Only about 1 million coins remain to be mined over the coming decades. But those remaining coins will not appear quickly. Bitcoin's mining schedule slows down over time. Every 4 years, the network undergoes an event known as the halving. During a halving, the amount of Bitcoin miners receive as a reward is cut in half. This mechanism reduces the rate at which new Bitcoin enters the market. The most recent halving has already tightened the flow of new supply, which means the number of fresh coins entering circulation each day is smaller than ever before. Combine that with falling exchange reserves, and the result is something economists often refer to as supply scarcity. Simply put, fewer coins are available to be traded. And when supply shrinks, while demand remains steady or increases, prices tend to move upward. This dynamic has played out repeatedly throughout Bitcoin's history. In previous market cycles, large amounts of Bitcoin were withdrawn from exchanges during accumulation phases. Investors stored their coins for the long term. Supply available for trading declined, and eventually, when demand returned strongly, prices accelerated dramatically. Now, the market appears to be approaching a similar moment again. Bitcoin exchange reserves are at record lows. Long-term holders continue accumulating. More coins are locked in private wallets, and the supply entering the market from mining continues to slow. At the same time, global awareness of Bitcoin keeps expanding. Institutional investors have entered the space. Major financial firms now offer Bitcoin investment products. Spot Bitcoin ETFs have opened the door for traditional capital to enter the market more easily than ever before. Every one of these factors increases potential demand, but supply remains fixed, and increasingly, that supply is becoming harder to access. This is where the combination of technical patterns and on-chain data becomes particularly interesting. The chart suggests a compression phase. The blockchain suggests tightening supply. Both forces often appear before significant market moves, but predicting exactly when a breakout will occur is always difficult.
Markets rarely move on a perfect schedule. They move when enough pressure builds. And right now, pressure may be building in multiple ways. From technical structures, from long-term holder behavior, from supply scarcity, and from increasing global attention toward Bitcoin as a financial asset. For investors watching the market closely, this combination raises an important possibility. The next major move in Bitcoin may not come from sudden news. It may come from structural forces that have been quietly developing for months. A tightening supply, a consolidating price structure, and a long-term trend that remains intact despite periods of volatility. Whether the market moves upward immediately or continues consolidating for a while longer remains uncertain. But one thing is becoming increasingly clear. The conditions that historically precede major Bitcoin expansions are beginning to appear once again. A veteran trader is pointing to an unusual chart structure. Exchange reserves are hitting record lows, and more than 95% of all Bitcoin that will ever exist is already in circulation, which leaves the market facing a simple but powerful equation: limited supply, growing demand, and a pattern that suggests the current pause may only be temporary. If those forces eventually align, the next phase of Bitcoin's journey could be one of the most significant yet. And somewhere inside that curved structure on Peter Brandt's chart, the so-called banana split pattern may already be quietly forming the path forward.